Hello, everyone. Good afternoon. Thanks for joining us today in the middle of your day to learn a little bit more about self-directed IRAs and mineral ownership. My name is Brittany Piquel. I'm the Director of Marketing and Sales for Next Generation, and our guest here today is Troy Eckerd from Eckerd Enterprises. He's going to speak with you about the mineral ownership industry, some trends, and then how this could be a lucrative investment for self-directed IRA, which is something that we'll cover together. Just a few quick housekeeping items. We're aiming to keep this within an hour out of respect for your time. Troy's going to go through his piece, and then I'll talk about the connection to self-directed retirement plans. The session is also being recorded, so if anyone didn't have a chance to attend live today, or if you have to drop off for any reason, you will all receive a copy of the recording that you can listen to later at your convenience. And if you do have any questions as we're going through the material, we're going to save a little bit of time toward the end to address those. So feel free to enter them into the question box on the right panel of your screen. Other than that, we will get started. And Troy, I'll let you take it away.
Thank you very much, Brittany. I appreciate it. First off, I want to welcome everybody to what should be a very nice, short, educational presentation regarding private mineral ownership in the United States. And what I would like to do is just go through slide by slide and then see if I can answer some of the questions that were provided prior to the presentation. First off, let me just introduce myself. My name is Troy Eckerd. I've been involved in oil and gas industry since 1985. And during the last 30 plus years, there has been a major change in the oil and gas industry in the United States. And as a result of those changes, two things have happened. One, we have become a massively positive oil and gas producer, meaning that we're now producing more oil and gas than any other country in the world relative to output on a daily basis. And the second thing is private investors are now able to look at and potentially own oil and gas mineral interest in literally millions of acres that are being developed by major oil companies, whereas before it was so limited and so competitive, it really was difficult for any smaller or private investor to become involved. So what is happening for you and I is that I would be able to provide you with 30 plus years of educational expertise to help give you input and feedback on how you might become a mineral owner within shale plays taking place in the United States. Let's get started. First off, I'll talk about what exactly is a mineral interest. Now, for those of you who have never been involved in actually owning a mineral, I'm going to make it simple. You have surface rights above the ground, and you have mineral rights, everything below the ground. The nice thing about owning mineral rights is that it is an actual real estate acquisition. You're buying tangible real property. So just like you might buy a corner lot, or you might buy a house, you might buy a building, owning minerals is actually a titled piece of real estate that goes in your name or goes in the name of the buyer, and it can in fact give you in perpetuity ownership, which is an excellent investment opportunity. It makes it very tangible and very fungible with regard to your ability to buy and sell it. It is your right as a mineral owner to lease your rights to maybe a major oil company to be able to kind of develop oil and gas wells on your property. And as a mineral owner, you act like a landlord. You're able to buy a mineral. Oil company wants to develop some wells. You'll negotiate terms that allows you to lease those minerals to that particular oil company, and they will go in and spend all the money to develop and produce the oil and gas that's underneath the ground. The nice thing about it, as a landlord, you don't pay for any of those costs of exploration. So as I'm going through this, just keep in mind minerals are what I would call a passive participation. You are the owner, but you're not directly involved in exploration. You're not involved in expenditures, involved in liability. You simply are the owner, allowing somebody else to take all the financial risk to make profit. Okay? So mineralship, let's talk about what the significant values are in being a mineral owner. First off, it's all about cash flow. We know with the income markets being so down in the last 10 years, really, that all of us are looking for ways to create increased value and cash flow. So how does cash flow come from minerals? Well, if I bought a mineral today and an oil company wanted to come in and develop the minerals that I own, I'm going to ask them to pay me a lease bonus. They're going to get the rights over maybe a 3 or 5 year period to have the right to develop oil and gas on my minerals and pay me a lease bonus. Now, that lease bonus can range in dollar amount and it can range in terms. But the bottom line is I'm making cash flow as a result of that lease. It also has to do with the actual sale of the oil and gas that comes out of the ground. Every single day across the United States, there's literally millions of shale mineral owners that are receiving checks every month for the oil and gas that's extracted from the wells that have been drilled on their minerals. From every day the commodity prices, I don't care if it was $50 a barrel or $5 a barrel. As a mineral owner, I paid my pro rata share, but I didn't for a single bit of the exploration. So every barrel of oil, every MCF of natural gas that's extracted from the minerals that I own, proportionate to my ownership, I get paid at the end of the month by the oil company that has drilled the wells and is managing and operating those wells. It's also very important to know that it is not limited to any particular formation or reservoir. In other words, in certain parts of the United States, there are areas that might have as many as 10, 20, 30 formations from 1,000 feet below the ground to 20,000 feet below the ground that have oil and gas trapped. So as a mineral owner, I own it in perpetuity. I own it forever until I decide to sell it. And every single one of those zones, formations, it doesn't matter. As long as I own that mineral, I'm getting paid for somebody else to extract oil and gas from underneath the ground. Also, I think it's important to know that minerals, because they're in perpetuity, can actually generate revenue for decades. There are mineral owners in West Texas that have literally been getting revenue checks monthly for the last 70, 80, 90 years. Part of the shale plays in this country, which is a big focus of the expanding opportunity in minerals, have wells that are predicted to last 40, 50, 60 years. So it is a brand new, exciting, dynamic opportunity in minerals as a result of the success of U.S. oil companies finding these shale formations and making them commercially productive. Okay. Now, one thing about mineral interest is that it's no different than real estate, really. If I were to drive down an interstate and I got to get on the edge of town, as I start to see kind of open pastures, I realize that maybe I'm going to pay $20,000 or $30,000 per acre to look at open pasture, but it's kind of close to town. Well, what happens is that as the expanse, as the city begins to creep out toward the rural area, all of a sudden that goat pasture becomes not worth $30,000 an acre. Maybe now it's worth $2 a square foot. And then as we see a Home Depot go in, now it goes up to $20 or $30 per square foot. Well, minerals are the same way. As oil companies develop particular mineral leases, those mineral interests that are adjoining, next to, or within a particular growing pattern of successful development by the oil companies, those minerals begin to go up in value. So one of the things to keep in mind is that the idea for buying minerals is no different than real estate. If you want to go out and buy a 6-story hotel and you've got cash flow for the last 4 years, well, you know it's going to be bought at a value based on income, location, and replacement cost. If you want to go out and buy minerals, it's the same thing. The lower you want risk, the higher you're going to pay. And so there is a real balance between what you do with risk and reward in buying minerals, and that takes expertise to kind of make that portfolio balance. Now, one thing that's very interesting, I think a lot of investors and potential mineral owners need to understand is that there's a certain amount of oil and gas in the ground. And all these reservoirs across the United States, there is a certain amount of oil and gas that is contained within a given mineral ownership area. But what really is important to understand is those particular economic oil and gas reserves that can be extracted really kind of grow. You say, well, how can they grow? I mean, it's just organic material. There's only so many dinosaurs that died in a certain spot, so many plants that were piled up. But the reality is that extracting oil and gas from your minerals has a lot to do with the economics of the oil company and their ability to go out and drill a well and extract those reserves. So what I've seen over 33 years is that when the price of oil started to go up, when I first got in the business in 1985, we were seeing oil as low as $11 a barrel. I've seen it as high as $145 a barrel. Well, an engineer or a CFO within an oil company can determine that based on the price of drilling and based on the price of production, you actually have X number of barrels of oil that are economically recoverable. As the price moves up, all of a sudden you as a mineral owner find out that your minerals are worth substantially more because you might have only had 100,000 barrels of oil estimated under your minerals, but when oil moved to $45, $60, $90 a barrel, that 100,000 barrels of oil now becomes 500,000 barrels of oil. It's not like the oil showed up, it's that the economics to pull that oil out of the ground happen. So if you're a long-term investor and you're very patient and relaxed and you like your monthly checks, that's great, but you also have a major advantage in the entitlement value and the commodity value of minerals. As the price of oil goes up, your amount of reserves that you'll get paid on goes up as well. Now, when is the right time to buy minerals? Quite frankly, I've been buying minerals since I was a kid in 1985. And I think buying minerals is no different than real estate. It's always about price, location, and market perception. So I can go out to West Texas and I can probably buy some land out there for $500 an acre if I wanted to buy, goat pasture and cactus. Or I can come in downtown Dallas and I can pay $100 a square foot. Is it good to buy it in a high inflationary time or in a low inflationary time? Is it better to buy it when price oil's up or price oil's down? And what I'm going to tell you is that any time is the right time to buy minerals because it's always about two critical factors. Location is number one, like real estate. Location, location, location. And it's about price. So if I buy it for the right price in the right location, it doesn't matter if oil's $145 a barrel or $30 a barrel. It has to do with location and price. And that's what I think is most critical for any mineral investor to understand is where am I buying my minerals and what price did I pay? Now, the key for us today might be, where is the U.S. energy market today? Well, let me tell you where it's at. It's recovering from a massive downturn in 2014. It is now put the United States in the front and center of being the highest oil producer in the world. We actually are outproducing Saudi Arabia right now. We literally have solved our energy crisis because these shale formations that are being developed in over 30 states essentially have a 99% success rate. They're finding 500,000 to 1 million barrels per well of reserves. They're talking about being able to drill 5, 10, 20 wells per 1 square mile of land. And we literally have just begun the effort in finding and discovering all the oil and gas that's within the shale formations that are inside the United States. So when we say where is the U.S. energy market today as far as a mineral market, what I see is this entire big buffet. It's a huge buffet. It's Golden Corral at 9 o'clock in the morning. I'm the first customer in the door, and I see us in literally the beginning of an all-you-can-consume type of a mineral market. Now, you might say, well, it's been going on for 10 years. How could we be in the first inning? Because what is happening is the technology and the advancements in the technology for discovering, extracting, producing oil and gas from these shale plays advancing so quickly that the oil companies are finding that what they thought might be marginal production 5 years ago is now incredibly good production. And what they have done in the last 10 years is really just scratching the surface. So as a mineral buyer, I find that there is enormous opportunity, a lot of chances for us as mineral buyers to make good profit and money and hold them in our portfolio. So we're not in a situation where only the crumbs or the undesirable minerals are put out in the private marketplace. In fact, we're buying minerals head to head with major oil companies and at really good prices because there is so much of abundance. The key is knowing where to buy and what price, as I said before. Now, where's the mineral acquisition today on the growth chart? Well, if you look up here on the screen, basically there's two maps. This is essentially Oklahoma and what the little colored geometrical layouts look like. These are just different gas and oil fields that are being developed in what's called the Woodford Shale. And I'm just using this as kind of a template to give you an example. But in each one of these colored areas, you might be dealing with several million acres of undeveloped land that currently are being defined as areas of high concentration of oil and gas in which major oil companies will be going in and drilling and producing. So that means whoever owns the minerals in these colored polygons up here are in fact in a very, very good position for seeing some really nice oil and gas value from the minerals that are owned. So if you happen to be focused on this particular area and you were able to get in and look at identifying the right locations, you can find yourself in position of being partners, a passive, non-capital exposed partner to letting companies like Continental Resources, XTO, Exxon, Shell, you name the majors, they're all out here in the shale play. So there is an opportunity for making excellent investments in minerals. And again, it's about just very simply understanding what you're doing. It's about minimizing your risk. And it's about taking baby steps, looking at buying minerals in a few acres at a time, doing it in a few locations at a time, and just slowly building your portfolio and mineral acquisitions. Now, what is the value proposition of owning minerals? So I'm all about numbers. I like dollars and cents, and my background is economics and finance. When I look at minerals, I'm looking at minerals very similar to buying real estate, except for a couple of factors. And that is, I want minerals because they're real property and titled in my name. I'm going to own them in my family and my trust. If I drop dead tomorrow, I'm able to put that in my estate and they transfer with very, very simple process and ease of title. Minerals generate liquidity. Every month I get envelopes in my office made out to my company, made out to myself, and it simply is a check. There's no expenses to pay. There's no unexpected capital outlays. It's the oil company who has produced oil and gas off my minerals, sending me a check every single month for my pro rata share. And my biggest labor for the month is stamping my deposit name and account number on the back of the check and putting it in the bank. Now, mineral owners, where the value proposition is, mineral owners retain a royalty interest. Let me give you a simple analogy. Royalty the name was derived from like a king and queen. It was royal to own the land and the minerals. So royalty interest means you as a mineral owner will retain a percentage of all the oil and gas pulled out of the ground from underneath the minerals that you own. And as a royalty owner, you're not subject to the labor, the expenses, the liability, the environmental. None of that is burdened by the mineral owner. The mineral owner sits back in your house, your condo, on your vacation, and you just wait for the mailbox to open up every 30 days to get your check. So the nice part about it is you get paid for every drop of oil and every MCF of gas, but you don't do anything other than just deposit your check. When you talk about return on investment, lease bonuses are the lease amounts that are paid to you as a mineral owner. In some cases, like the area that we're working now, we're going to buy minerals for $6,750 an acre, but some of the oil companies are paying as much as $3,500 just to lease it. So that's over 50%, or roughly 50% of my purchase price I'm getting back in the form of a lease from an oil company who wants the contractual right to go in and drill wells and develop those minerals. So there is a nice value return on a lease bonus. You also get, like I mentioned before, the monthly checks that come in. You get multi-reservoir leasing opportunities. Here's what I mean by that. So think about a layered cake. From the surface down to 10,000 feet, there might be 5 or 6 known formations that hold oil and gas that can be exploited over time. You can be in a situation as a mineral owner, which happens quite often, where you've leased certain depths to one company and certain depths to another oil company. You might have 2 or 3 oil companies developing wells on the same mineral acre, or you might have one major company who says, we'll develop all those different formations and we'll do it subsequently or sequentially together at one time. And then, of course, there's the sale proceeds when you sell your minerals. Now, one thing that's really important to understand is that the fact that you own these minerals allows you to own them and sell them whenever you think the timing is right. And so the key for us as mineral owners to know that we can enter and buy and we can exit and sell whenever we feel, because there's a really high demand for minerals. Now, as we move through the presentation, because I don't want to run out of time, I'll tell you this. Anybody can buy a mineral interest. You can go on EnergyNet, you can go on Clearinghouse, you can go on all these different sites, and you can go on and there's mineral interest for sale everywhere. You can go in Craigslist and find a mineral interest. But I'm going to tell you right now, you can buy minerals in the wrong location and you'll never see an oil well ever move on your property. And unless you can figure out how to get a hole in the ground and extract those oil and gas reserves, you're not going to make any value. Remember, the values in lease bonuses, revenue from the production, and the eventual sale of those minerals once it's been entitled through value such as commercial production. So how are you going to know when, where, and how to buy? Okay? Well, anybody can look at a picture and say, you know what, this is a beautiful farm. There's an oil well in the middle of it. I'm sure that rancher and farmer's happy. I see a couple of houses next to it. And the question is, do the folks at the bottom of the picture, do they own any of the minerals underneath that rig? Or do they happen to be right next to a successful well, hoping that the oil and gas reserves under the ground actually will include their minerals? So what you have to do is decide what level of risk. Do you want to buy open goat pasture and pay $200 an acre and knowing that it may not get drilled in your lifetime? Or do you want to be in one of these houses next to a rig and willing to pay maybe $3,000 to $5,000 an acre because you know there's a high probability you're going to find oil and gas into your property? Or do you want to go out and pay $15,000 to $30,000 an acre because there's already wells drilled, they're already producing, and you essentially have had your minerals de-risked because of exploration and success? So it's all about knowing where to buy and the price you pay. Now, you and I and anybody can literally look at this map, and this is West Texas, and every one of those little white dots out there represents an oil well and a pad site where the oil well and the equipment are stationed. So when you look at this picture, anywhere on that picture, somebody's getting a mineral check every month for the minerals that are being exploited. And that's essentially what's happening all over the United States when it comes to these shale formations. Not necessarily this ugly per se, but you're seeing oil wells drilled on half mile, 1 mile, 2 mile sections of land, and they're drilling horizontally and they're extracting the oil and gas out very successfully. And what you can do is say, well, do I want to be in the middle of this and buy minerals? Well, yes, you can. But that's like buying the 1 acre lot next to a Home Depot and a Lowe's. You know that property's not $30,000 an acre. It's more like $25 a square foot. So do you pay $30,000 an acre, or do you pay over $1 million for that acre once you have a Home Depot and a Lowe's. In this area right here in West Texas, some of these folks are paying $65,000 to almost $400,000 per net mineral acre. It's insane prices, but it's been completely de-risked, and that's more of what I would call a hedge fund or somebody who has long-term patient money, which is generally not the private investor. Now, geologically proven basins, they're everywhere. We know where the basins are. We know where the dartboard is. We just have to decide, where are we going to aim? Are we going to aim for the bullseye? Are we trying to get to the outer circle? And that goes back to understanding the geology. So really, I think mineral investing is not that hard. It's very simple to do. You just need to have a company or somebody who's going to guide you and give you the right information to know which minerals to buy and, of course, at what price. Now, these are the type of companies that we're talking about. So the big word for the last 10 years has been the word shellionaire. Now, what is a shellionaire? A shellionaire is an investor or a mineral owner who has been able to convert the minerals they own into million-dollar net worths and more, because the oil and gas contained under the ground ends up resulting in so much money that they're becoming millionaires by virtue of owning shale rights. One of the key things to remember, though, is that the people that are doing all the risk-taking and taking all the money and putting it to work are multi-billion-dollar oil and gas companies like XTO, which is an Exxon company, Continental Resources, BP North America, EOG, etc. So we own the minerals, and our tenant, if you will, that leased our land, are worth $30, $40 billion, and they're out there today saying we want to drill as many wells as we can drill. So the other thing to keep in mind is that all of this has occurred, all of it has occurred as a result of modern technology. Because we knew there was shale 20, 30 years ago when I started my career. Nobody could figure out how to take this hard rock, which was completely saturated with oil and gas, and how to make it where the oil and gas would free flow and come out of that hard rock in the form of expanding gas and oil molecules. Well, there was a big success back in the 1990s by George Mitchell with Mitchell Energy. He discovered how to drill horizontal wells and then stimulate these formations with natural sand and natural water and allow these things to produce. If you look at the photograph on the left, let's just call this 2 square miles or 2 sections of land. You might end up with as many as 12 or 24 wells pulling out somewhere between 4 and 10 million barrels of oil. And then on the picture on the right just shows you how neatly the location or pad site is. It's going to be 5 or 6 pump jacks. And you and I, as a mineral owner, own 5, 10, 20, 50 acres out of that 2 sections of land. And every time those wells produce, we get paid every single month. It's a pretty simple process. So the risk of it, let's talk about the risk of mineral ownership, because this is always a concern. Well, if it's so good, then why isn't everybody doing it? Well, I've asked that myself for years. As I've gone out and looked at buying minerals, I always scratch my head and said, why did somebody else not buy these minerals? And the reason is, back to my first analogy, this is a buffet at 9 o'clock in the morning. There are millions upon millions of acres of land, and these big companies are buying billions of dollars of leases and minerals, and then they're spending 5 times that in exploration cost. And what has happened is the buffet is so large and is so expansive, covering 30 states, that there is a window of opportunity, and I hate that cliche, but it is true. There is a window of opportunity for probably the next 5 to 10 years where private investors like you and I can actually put some of our hard-earned money out of our IRAs to work, buying these minerals, and then these companies go out and develop and making us capital and increasing our reserves. So the first thing I always say is, well, you got to make sure the guy you're dealing with is not a crook. Okay, we got to make sure that what we're getting is straight information and we're getting an honest opportunity to acquire minerals. The second thing is, I can't overpay. It's like anything else. If you overpay, you're automatically upside down, or at least kind of squeezed your profitability to a minimum. If I pay $20,000 for an acre of minerals and there's only $22,000 in potential value, but doesn't leave me much of a margin for profit. You can also buy them in the wrong geological location, and that happens. And in the current environment, though, with shale, we don't believe that if you focus on shale plays that you're going to be in the wrong location, because these wells are like 99% successes, because the shale is a big, thick zone that covers literally million acres. So see the geological component, but not a practical component if you're inside of shale area. And then you also look for commodity price. That just mainly means that when oil prices dropped in 2014, we went from 1,900 drilling rigs active in the United States down to 417 rigs. And then over the last 2.5, 3 years, they're now back up to almost 1,100 rigs. So you have kind of this accordion effect. As the price goes up, we add more rigs and we drill more minerals. As the price goes down, we drill less minerals and less acreage. So as a mineral owner, we're always in the same thing like real estate. It's ebb and flow. The ebb and flow has to do with capital, cost of capital, and access. So there are multiple reasons to buy minerals. Quite frankly, I think every investor out there that is qualified to invest should be a mineral owner. What you want to do is, for probably what I think less than a nice cruise or family vacation, you can actually be a mineral owner in the United States. You need to seek help and advice to figure out which minerals to acquire. And of course, remember, it's real property. As you retire and move up toward planning your estate, what you want to remember is it's very easy to pass on to your kids. A lot of my investors in the past buy the minerals and they leave it in their estate, and it's very easy for them to transfer to their kids, grandkids, and even their non-charity organization they like to give to. So how do you want to learn more about becoming involved in minerals? Well, our company is Eckerd Land and Acquisition. Our business development manager is Ronnie Aroche. Ronnie has his email up on the screen. You can contact him at our 800 number. It's quite simple. Minerals are like trains at a train station. They come along every 15 minutes. There's no emergency. You don't have to get on because this is the last one to show up. The fact is, it is like savings when you were a kid. You know, somebody tells you at 21 years old you need to put money in your 401k and your IRA, and you say, yeah, but I got to buy groceries and diapers and take care of my growing family. But the sooner you start, the sooner you build wealth. And so to me, my answer is today is the time to be in minerals as fast and as aggressively as you think you can. Decide what your strategy is, ask the questions from Ronnie and our team to figure out what makes sense, and then we'll assist you in doing your homework. If you don't ever do any investing in minerals, at least you become a lot smarter and a lot wiser, because the fact is minerals are going to cover a lot of land over 30 states in this country, and it is something that you should be aware of. So, again, my name is Troy Eckerd. I am the CEO and manager of Eckerd Enterprises, and the question I always ask or get asked is, should I be a mineral owner? Well, if you're qualified and you are looking for tangible assets that have cash flow and upside, the answer is absolutely yes. I really appreciate your time today, and I hope that I've been of some value to each and every one of you. Thank you.
Thanks, Troy. Very interesting information. I know for myself as well. I am going to now talk more about self-directed IRAs, as Troy kind of alluded to. Just for anyone who's new to this concept, I'm going to run through some of the basics, and then we can talk a little bit about some restrictions and some guidelines specific to mineral ownership that you should be aware of. So just real quick, again, as I mentioned earlier with Next Generation, as far as our role in this whole process, we are essentially just record keepers and administrators for these types of retirement plans. We're not advisors, and our specialization is in holding typically non-publicly traded, or also known as alternative assets. So our goal is really to make sure that we're reporting the proper information to the IRS, that we're educating investors as far as what's expected of them if they own a self-directed plan, and making sure that they understand the IRS regulations that are going to basically guide them through and understand what they can and can't do, and how to be as successful as possible by having as much information as they can. So just real quick, a little bit of background on the company. We've been in business since 2004. We are headquartered in New Jersey on the East Coast. Our founder and CEO is still here running the show, Jamie Raskolnik. She's actually founded the company out of a desire to make some real estate investments within her own IRA, and she was unable to find a way to do that. So she joined a national network of third-party administrators of these types of retirement plans, and then she decided to break away from the network and start her own business. So we are now a trust company as well, and I'll talk about that in a moment. But just thought the history would be important to understand, as she actually owns a property management company herself, so she's very into real estate, and she's been in the business for quite some time. So just a quick disclaimer is what we don't do. I mentioned it earlier, we don't advise and we're not fiduciaries. So our goal is primarily to provide education. And that said, it is important that if you are going to use a self-directed retirement plan and choose your own investments, that you do your own due diligence. And Troy mentioned some of those things earlier and things to look for. And you should consult with other resources as well. To be as successful as possible, you really need to have a good team of resources, including a good tax advisor and even potentially an attorney that understands not only investing and the basic laws, but also understands ERISA, which governs self-directed retirement plans and other types of retirement plans, and can help you through evaluating how to structure some of your investments. So, okay, what actually is a self-directed IRA? It's a retirement plan that works just about like any other that you might have, but the difference is what it allows you to invest in. So if you have an account with a brokerage like Fidelity or Schwab or Morgan Stanley, you're going to be invested in publicly traded assets, right? Stocks, bonds, mutual funds, et cetera. If you ask them if you can hold private real estate in your account, they're most 9 times out of 10 going to tell you that that's not something they offer, right? Because they typically have a menu of options for you to choose from that have been already pre-vetted and approved, and things that they will allow you to invest in. So this just opens up the options for you. It doesn't come with as many limits as far as what you can actually purchase and hold in your retirement plan. So obviously, one of the benefits there is if you have experience or interest in a particular area, you have more control over the investment itself and potentially the return on the investment, especially if you have experience in real estate, or as Troy said, you have a more passive investment where you're more involved in the decision making, but you can sit back and collect, a check every month. You kind of know what to expect and what you're getting versus being subject to the volatility of the stock market. So this is not meant to put all your eggs in one basket and put all your money into a self-directed plan, but it's another way to further diversify beyond publicly traded assets into something that you can control. And then obviously the other benefit here is the tax advantage, right? So when you yield a return on your investment, you could of course do anything with personal funds as well, but when you're using a retirement plan to do so, the earnings are going back into your retirement account, and depending on what type of account you have, those earnings are either going to be tax deferred. So obviously there's value in that as well to consider. So types of plans that you can establish as self-directed retirement plans and that we can hold. Obviously, you'll see the most common are traditional IRAs and Roth IRAs. So most of you might already have those, right? Traditionals bring you tax-deferred earnings. So after the age of 59 and a half, you can withdraw without penalty, and then those withdrawals are subject to income tax at that time, depending on where you fall. Roth IRAs just work the other way around. Money that goes into them is taxable for that year when it's contributed or rolled over or transferred into the Roth. And then those earnings grow tax-free forever, which is a really great benefit. It's just really important to understand the differences there. It's not that one way is right or wrong. It's just important to know that there are different tax implications. For self-employed, if you own your own business, you can establish a SEP IRA, and that comes with higher contribution limits on an annual basis, which could be a benefit for those who don't have an employer-sponsored plan already. So you're able to contribute a portion of your compensation every year into your SEP IRA, and the limits are much higher. They're actually slated to $56,000 for 2019. And then some other plans, also for self-employed, you can establish your own 401k plan for your business. If you don't have common law employees under the plan, you can self-direct that as well. And then the less common but important to know are covered-out education savings accounts for children. So you can actually withdraw those funds tax-free if they're used for a child's education up to age 30. And that covers pretty much anything from kindergarten to secondary college expenses. And then HSAs, health saving accounts, can also be used more strategically than just to hold cash. You can actually actively invest the funds in a health savings account, and of course, as you know, for qualified medical expenses, those can be withdrawn tax-free. So ways to get money into a self-directed plan, as I just alluded to, you can make a personal contribution, which would be basically taking funds out of your own personal account, checking your savings, and depositing them into your account on an annual basis. The IRA has limits they've set. You can also transfer funds if you have them in another IRA, like with a Fidelity or Morgan Stanley or Schwab. You would just have to liquidate whatever assets you have there to give yourself enough cash to be able to transfer to the self-directed account, and then with that cash, you can use it to invest in anything that's allowed. It is not a reportable or taxable event to transfer between IRAs, and there's no limit to the amount or frequency with which you can transfer. So it's good to know that. If you don't have money in an IRA, but you have an old 401k that's just kind of sitting, you can also roll those funds over into an IRA. There's a slightly different process for that, but it's just as beneficial and just as pretty straightforward to do. And then a conversion would be moving funds from a tax-deferred type of account to a Roth, as we mentioned earlier, to which would be a taxable event, but then once they're in the Roth, they would grow tax-free from there. All right, so possible investments. Obviously, today we talked about mineral ownership, and basically that would fall under kind of a real estate category, land acquisition. But there are all sorts of other things. Essentially, anything that's not publicly traded. So these types of asset classes are really popular. What you see here, private equity, lots of private equity, hedge funds. In the real estate space, also mortgage notes and tax liens. Precious metals can be held in a retirement account. Cryptos can be as well. The only two things the IRS does not allow to be held in a retirement account are life insurance and collectibles. So anything that would fall into like an antique category is not allowed. So if you've looked at what you're interested in and it doesn't fall into these categories, you can own it in an IRA. Now, how the IRA is actually held and maintained is by having two components that are needed for this to work. One is a custodian that's going to actually hold title to the assets within the plan, and then that custodian is also a regulated financial institution that's going to report to the IRS what it's doing and what's happening with the account. And then the other component is the administrator, which is going to be pretty much that customer service component that you're going to interact with directly, that's going to service the account, provide account management, and then actually process the investment transactions for you. So Next Generation has both components. We're chartered in South Dakota as a trust company, but account holders can invest anywhere. And then we have the Next Generation Services, which is that customer service arm, which is located in New Jersey. So some different ways that you can invest. Once you've determined if the asset you're interested in can actually be held in a retirement account, you can directly purchase an asset in the name of the IRA, which in the case of today's topic, you could potentially purchase this mineral land, as property titled to the IRA. There are other ways to invest into property and other types of assets. If you don't have enough on your own to go into a purchase, you can partner with either another individual with their personal funds, or you can actually partner with your IRA as well. So that's possible. Promissory notes and loans allow you to use your IRA as a lender. The IRA can also borrow funds in certain cases, but that comes with a different set of requirements. Just know that you can actually lend funds to an entity as well. And then, of course, you can directly invest into a privately held entity, whether it's an LLC or a C Corp. The only stock you can't own with an IRA is S Corp stock. So it's just important to know that as well. But you can basically form JVs, limited partnerships, using a retirement account. So it'd be great if it were just that straightforward, but there's just another layer of regulation that comes with using an IRA to make investments. So it's really to understand prohibited transaction rules. These are defined in the Internal Revenue Code, and they basically lay out what an IRA can't do when they're investing. The first thing that they list here are what they call disqualified persons, meaning the IRA can't buy from, sell to, lend to, borrow from, or exchange any type of ownership stake with these disqualified people. So obviously you yourself as the owner of an IRA would be disqualified from investing directly with it for conflict reasons. And then any spouse, children, so basically ascendants, descendants, and their spouses would be considered disqualified from investing directly with the retirement account. Fiduciaries, which might be an advisor that you're using on your account. And with that, entities that are majority owned by disqualified persons. So if it's a family-owned business, for example, that you wanted to invest into, unfortunately, if it's 50% or more owned by anyone that falls on this list, that wouldn't be an option. And then people providing service to the account, which would be like a Next Generation or somebody that's actually managing the account. These are three different types of prohibited transactions. In terms of what we're talking about today, the first one is really just about engaging directly in a transaction with a disqualified person. So if you were to purchase mineral land with your IRA that was owned by somebody that's a disqualified person, that would be a prohibited transaction. So you just want to make sure that you're focused on doing these things for investment purposes only with an IRA, and that you're really in it for the long haul, right? Because we're using a retirement account, and the idea is to build long-term wealth for retirement. Of course, at the time that you either start taking funds out or you have beneficiaries listed, you could, of course, leave those assets behind to a trust, estate, directly to any loved ones or anyone else that you deem. But as long as they're in your account, you want to make sure that you're really looking at this as a long-term strategy, which is why people really like passive investments with these types of accounts, because they're a lot simpler to manage. Extension of credit would just be personally guaranteeing a loan that's taken by your IRA. Self-dealing would be double benefiting from an investment. So let's say an IRA purchases land, but then you are living on the land personally and benefiting from the land, or you're getting some sort of personal compensation related to the IRA's investment. Those things are things you want to ask yourself about before going into an investment. They're things that, as an administrator for the account, we actually provide, I guess I would call it a compliance review on every investment before processing any transaction to look for these sorts of red flags. And of course, our job, again, is to make sure that we're educating individuals prior to making investment decisions so they're able to walk themselves through this type of process, but we also provide the support to minimize the risk of any prohibited transaction occurring. So some specific restrictions on real estate. As I mentioned earlier, you really want to make sure you're looking at this for investment purposes. If your IRA owns something, like land, for example, you're not able to go and then personally alter the land or contribute sweat equity to improve the value of the land. If you own mineral land, I'm guessing that nobody would want to do that. It doesn't sound like an easy process to do that, but it is important to just understand that you're not allowed to do that or let anyone that's on that disqualified list use the land, live on it, provide services to it, repair it, anything of that sort. And then if you are going to purchase something, you don't want to go ahead and purchase it personally and then try to transfer it to the IRA, because as we mentioned earlier, that would basically be a prohibited transaction. It would be transferring ownership from yourself personally to your retirement account. So you want to start out fresh with the IRA as the purchaser in this scenario. So just real quick, in terms of getting something like this set up, you would need to open a new account, a new retirement account, which just takes 1 to 2 business days with the completion of an application. Funding it through one of the methods I mentioned earlier, which could be a contribution, a rollover, or a transfer. It can take as little as a few days, honestly, but this is a really conservative estimate, but usually the reason for the variance in the timeline is just the other custodian that's holding your funds currently and the requirements that they have for letting go of those funds. They all vary, so it just depends, but that's something that we help facilitate. We're familiar with most of the major custodians, so we've been through the process many times with them. And then making the investment. You want to get some paperwork together, which I'm going to talk about in a second, and then you want to submit that to your custodian to basically review, and that's your way of directing them to make an investment on behalf of your retirement plan. There's some supporting documentation from the investment as well, and I actually spoke with Ronnie and Troy about this, and on the right-hand side, you'll see the documents that they typically need for a purchase is a purchase acknowledgement and then a sale agreement, which is basically the contract. And those things we would need to look at to make sure that the owner of the property is titled properly. It should be titled to the IRA's name if you're using your self-directed IRA. And then our office would actually sign that contract on behalf of the IRA as the investor. As the owner of the IRA, you would mark them read and approved that you reviewed them and that you agree to these things. But we would have to sign it as well. And then the internal documents on the left side are just docs that we would ask you to complete to basically, again, provide us direction to purchase an asset, or when you're ready to make a sale, sell the asset as well. So it would be a very similar process there. So just real quick, just a visual depiction of all this, because it can sound like there are a lot of moving parts. As the account owner, once you've established your account, you would contact, and obviously you've identified an investment, you would contact your custodian and administrator and let them know, hey, I want to invest and purchase this mineral land with my IRA from so-and-so. They would after reviewing the paperwork associated with that investment, release the funds to the entity. And then when that yields a return, that return is going to go right back to your retirement plan. So in this case, that monthly check, the lease bonuses would be written out to the IRA, and then they would be sent directly to the office where we would deposit them into your account for you. Of course, you have access to look at your account, and if you wanted to make a withdrawal from the account, you're always able to, just remembering that there are different tax and penalty implications depending on your age and your circumstances. But essentially, it's yours. And just remember that all the funds associated with the investment have to flow to and from the retirement plan in order to keep them tax protected. So that's just kind of a tip of the iceberg as far as how self-directed retirement plans work, how you could potentially use one to purchase mineral land and benefit from that from a tax advantage standpoint, as well as using a retirement plan as a vehicle for passive investments that aren't subject to the same volatility that they might be in the stock market. If you want to learn more, there's a ton of information on the website, or you could reach out directly. We do these webinars about once a month on a variety of topics, but if you'd like to learn more about this month's topic, you're free to reach out directly to Troy or Ronnie as well. At this point, I'm just going to take a look and see if we have any questions that came through. Troy, I think that there was one for you that came through as you were talking. Let me just pull this up. Yes, so this question is, how do I know if a driller is tapping minerals on or below my property using directional drilling from another parcel? Sounds pretty specific.
It won't take long to answer that. So first off, with the oil and gas industry being almost 100 years old, there are very specific rules and regulations about where the placement of oil wells are relative to property lines, lease lines, legal descriptions. And so what happens is every single well is tracked by GPS as far as where the drill bit goes and, of course, where it's placed based on permits. So if I happen to have a mineral lease in a given legal described tract of land, when that permit is filed, I get notified that there's going to be a well drilled. And of course, if it is on an area that includes my minerals, I get notified that in fact I'll be included or pooled in that particular mineral ownership. So there's no way to ever delineate if there's shared reserves from, a guy next door to me to here. But what they've done is they've come up with a very general declaration of lines and specific titled ownership that separates one mineral owner from another, very much like a checkerboard or a chessboard. It's cut up into sections, it's cut up into geometrical design, and then you're included if that is the permitted area in which that well is going to be drilled. I hope that answers the question, but it's very, very clearly defined who owns what and how the wells are drilled and where they're drilled and how far apart they are.
Okay. Thanks, Troy. Appreciate it.
Yep.
That was the only question that I see. I don't see any other questions. Since we have a little bit of time, because I guess I sped through that faster than I thought I would, if anybody has any questions, feel free to enter them and we'll kind of hang for a minute here. Whether it's related to, how accounts are set up, how the retirement plans are established, who's doing what, the process with working with Troy or Ronnie as far as mineral land ownership. The participant said, thanks for your answer, Troy.
Yeah, no problem.
So one of the things actually that I think I had spoken to Ronnie about was who manages all of this. So whether you're using personal funds or a retirement account, Troy, and then the land is purchased, who is managing communication related to what's happening and interfacing with all these different...
Well, there's a great question, and there's a very simple answer. There's two ways in which we work with our private investors. One, we do have some pretty sophisticated partners that are retired geologists, geophysicists, people that have been in the oil and gas industry. And what they'll do is they will acquire their minerals, and then they will actually take title or ownership in their own name. And so when that is recorded in the courthouse, the oil companies are put on notice who the actual owner is, and that communication then, as well as the checks, will go directly from the oil company to that named party who bought those minerals. In many cases, probably 90% of the time for us, our investing partners like us to handle the location, the acquisition, the filing of the title of the minerals, and then when they acquire minerals from us, they prefer the minerals to stay in Eckerd Land and Acquisition's name, because then the oil company contacts us and they say, Eckerd Land and Acquisition, you're the named party. Maybe we've got 20 partners, individual owners that own the minerals, but the named party is our company. We then will negotiate the best lease price in terms of the royalty, and we will do that on behalf of our clients. And that's, I mean, we literally do that for almost no fee, because it just doesn't take a lot of effort to lease and to manage minerals, because it's a pretty simple process, mainly just one negotiated contract and then checks every month. So any IRA, self-directed IRA participant can make that choice. I want to take in the name of my IRA and I'll manage it myself, or I'd like to have Eckerd Land and Acquisition do it, and then Eckerd Land and Acquisition will send checks out every month to our investors. So it's really whatever they choose. But it's all titled, it's all in the courthouse, and it just depends on which way you want to go.
Sounds good. Thanks for answering that. Actually, as you were talking, another question came in. I'm not sure if this question is specifically for Troy or for myself, or maybe for both of us. So if you could clarify that in the question box, that'd be great. But the question is, how about the management fee, and is the fund SEC regulated? So I guess if for you, Troy, I guess the question would be about fees related to management that you were talking about.
Yeah, the way our company deals with minerals is we don't do it in a fund. You actually buy the minerals directly, so it's like buying a piece of land. It is SEC regulated in that we do file blue sky filings in the state in which a particular investor is involved. And we do have a purchase agreement that has disclosures on it that basically reflect the way we bought it. It tells you how you're taking ownership, and that it complies with our disclosure requirements under the SEC. But like a piece of real estate, essentially it's all going to be reliant upon the written document that says, here's the legal description of the minerals, here's the purchase which you're making, here's how you want to take title, and do you want Eckerd to manage it or do you want it yourself? It's either way. So minerals are considered a security, and they do fall underneath the SEC's guideline. And our job is to give you the disclosure that allow you to have that information as a qualified investor. And then, of course, it falls under similar transactions like real estate, where you'll be relying on the written documents for your decision making.
Okay, thanks. There's actually a follow-up question. So to that, from the same person, is it acting as GP or real estate broker?
Neither one. Essentially, a general partner would mean that it's in a partnership, or that there's some kind of fiduciary duties that's going to continue on. We literally could sell minerals today and assign them out. There is no ongoing management duties or responsibility, so it will not be a general partner. And when you talk about like a real estate broker, there might be some similarities in that the way our company works with minerals is that we take the lead and the risk. We identify the minerals. We go out and spend the money for due diligence, the landman costs, which can be several $100,000. We will acquire the minerals that we believe are the right ones to buy. And then what we will do is we will charge a fee per acre, and we might retain a small part of the royalty. So that's how we make our money. In some cases, though, we will actually buy them and let them become entitled, and then that partner can buy them when they become de-risked. So I wouldn't describe it as a real estate broker. What I would describe it is that we are in the mineral acquisition business, and we do have private partners who like to rummage through our inventory and decide minerals that they would like to buy based upon, again, the status of those minerals, the quality of the minerals, the price, and the timing.
Okay, makes sense. Thanks. One other question came through. This one's for me. This investment trigger UBIT. For anyone who's not familiar with what that is, it's unrelated business income tax. So when you're investing with an IRA or a retirement plan, there can, in some cases, be a certain type of tax that the IRA is responsible for paying. And that's typically in a case where you're doing more active investing. So in this case, while I'm not an attorney or a tax advisor, I'm fairly confident that UBIT does not apply to this type of investment. But if you want to be sure, you can always consult with your tax advisor. However, an example of an investment that might trigger UBIT would be someone who's doing frequent fix and flips of real estate property in an IRA to the point where essentially they're running a full-time business out of a retirement account. So this whole problem with UBIT came about, actually it started with NYU when they had a cafe that they were running, and since they're a nonprofit, they were able to charge very competitive pricing on their items, and other obviously other competitors in the area, other restaurants, cafes, etc., were complaining that it was an unfair advantage to them as a nonprofit because they were a tax-exempt entity and they were using that as an advantage to gain more business. And so with that, the rule was instituted that if that is the case, that whether, regardless of its tax-exempt status, the entity is responsible for paying a certain tax. Only if you're using the account as basically like a business. Like if you were to buy a franchise with an IRA of some sort of like retail business and then run it out of the IRA, those are the types of cases where you would see that applicable. So hopefully that helps. Another question came in: what is the expected ROI for the specific mineral interest you're offering in the Scoop stack?
Repeat that one for me if you would.
Sure. What is the expected ROI for the specific mineral interest you're offering? And then it's in the Scoop
stack
/ stack. Is that the specific?
Well,
yeah,
that's a great question. And so essentially, Brittany, and to the listeners, again, the return on investment is probably going to be a moving target because we don't know which mineral we're buying. So let's just talk in general what the oil companies are doing. The oil companies are spending $11.5 million to drill a well that they hope has between 600,000 and over 1 million barrels of recoverable economic reserves from that $11.5 million investment. That's about a 3.5 to 1 economic target is what they're looking for over about a 15-year period. As far as a mineral owner, if we would have to calculate three things to figure out what that return on investment is. We'd have to calculate what our purchase price is. So I can use the current minerals that we have, which is $6,750. We then would have to determine how many wells, or at least how much oil and gas we believe will be extracted from those minerals in what time frame. In the area that we're currently buying minerals, we're seeing a major oil company drilling one well to establish the production, and then we're seeing as many as 5 or 6 additional wells drilled. But in the package that we've been developing the last month or two, we believe that, let's just use a round number, $100,000 invested would potentially provide well over $500,000 in economic value over the development life of the property. As far as a return on investment, it is always critical to know the timing. So what we try to do is we like to buy minerals we believe are actively being developed, meaning there's a rig active, there's wells being drilled, we know there's a high probability of a well being drilled on the minerals we own, so therefore we move into a return on investment by virtue of the cash flow or the lease bonus that we receive. I personally am not looking to buy minerals for my account or those of my investing partners that can generate well over 10% rate of return. And typically, I'm looking for more in the high teens, low 20s as a rate of return. And I will finish with this comment, Britt, and that is my philosophy as I've gotten older, I'm 54 now, is AML, aggregate, maturate, liquidate. And what I'm doing is aggregating mineral interest now. I want them to maturate or mature over the next 3 or 4 years as these oil companies drill wells and start cash flowing my minerals. And then it's my intention on liquidating my minerals, or most of them, probably in the year 5 to 7. Now, if some of you are more long-term and want to transfer that wealth to your heirs, that's great. I'll do the same thing with a bunch of my minerals. But the reason I have the AML strategy is it allows me to recognize my gain. It gives me an exact exit point. And also, I believe that's kind of the strategy in oil and gas. It's about 7-year cycles like many industries. And there is many, many frothy buyers who will pay ridiculously high prices for cash flowing minerals. And so I want to play to that market demand. I hope that answers the question, but that's essentially what we're looking at in the Oklahoma scoop and stack.
Thanks, Troy. Last question, and again, that individual thanks you for their answer. Very courteous individual today. Is the company regulated by any state or federal agency? As far as Next Generation is concerned, we're regulated by the South Dakota Banking Commission, which is a state in which we're chartered. But Troy, I'll let you answer that on behalf of Eckert.
Sure, no problem. I essentially had a FINRA registered firm for almost 20-something years, but I don't have any brokers or salesmen. My company is made up of 10 individuals, and we basically have a bunch of accountants and operational people. And I have Ronnie Arochi, who's been with us for about 6 years, who runs our business development, which works with our private investors. So what we do is we are basically managing in a principle of our own investment products. So therefore, we do not have to be registered with the FINRA firm, but we do follow and comply with the state of Texas. And in the various states in which our investors are in, we do comply with the SEC filings such as Blue Sky. So we follow the state regulations, and we also follow the SEC guidelines for being able to work with accredited investors across the country.
Great. Okay. Well, I know we're just we really appreciate everyone's time today. Glad we left all the time we did for questions because we got some really good ones. And if you have additional questions, don't be shy. You can reach out and we can chat further with you one-on-one if you feel more comfortable. We're available. And again, you will receive an email with a copy of the recording for your convenience. So thanks again, everyone. Enjoy the rest of your day and week and happy holidays. Take care.